Joining me is Amit Kumar, who is managing partner of Artham Capital Partners. Amit, welcome.
Thank you, John.
Well, it's a great pleasure to have you here. By the way, I should also mention that you are adjunct professor of finance at Rutgers Business School. You're working on a number of interesting things, and I look forward to delving into those. But before we do that, maybe you could just tell us a little bit about your background and what you're focused on today.
Sure, John. So I am an independent research analyst, and I sell long and short equity ideas to money managers. In terms of my background, I've been in the technology industry for about 7 years until I went for my MBA at Columbia, and that's where sort of my investing style got shaped. And out of Columbia in 2007, I joined Swiss Re Asset Management in their long-short group as an analyst. It was a prop desk managing about $700 million of the insurance capital. And initially joined as a structured credit group for a few months, and then eventually moved on to the long-short group. Unfortunately, Lehman happened in 2008, and our fund had to wind down. And after a few months, I decided to go on my own and start selling my ideas to the money manager. So that's pretty much the long answer to my background in investing.
Well, maybe we could talk a little bit about how you go about your equity research process and how you generate ideas. So I'll let you tell us about sort of your secrets to identifying either great long or short investments.
Sure, John. Thanks. The pool of ideas obviously is huge, and in terms of my stock selection process, I try to stick to a few things. Briefly put, I rely on a universe of stocks that I've covered in the past. So as I mentioned, I started my career on the structured credit desk. So naturally, I had a good sense of financials, especially because I started at a time when we were going through the beginnings of financial crisis. This was 2007 summer, and that's the first time when credit spreads peaked. So that's one universe I think I've covered pretty extensively at the beginning of my career. So that's where I naturally tend to focus on in terms of picking my ideas, financials. Beyond that, I cover energy stocks. I cover retail. I also cover other consumer stocks, some healthcare, and depending on sector, company situations, it's always a unique angle, and there's no right answer, to finding stocks, as anyone would tell you. So for me, it's a combination of looking at the coverage space that I have done, screening for new ideas, and looking for certain key benchmarks that I tend to look for, especially on the long side. Now, because I sell both long and short ideas, one thing I've come to learn over the last few years of my business is thinking about short ideas requires a different hat, to putting on a different hat than thinking about long ideas. So in terms of the long ideas, you can pick up a great company which is cheap. It may lack catalyst, and you can still hold on to a longer-term universe, long-term holding period, and say 1.5 to 2.5 years, even if there's not too many visible catalysts. On the short side, though, the valuation obviously is important, so is the business model, but the near-term catalysts are equally important. So I think the way to view the two ideas are completely different for me. So let me focus on them one by one. So on the long side, I tend to look for companies with strong balance sheet, good return on equity profile in the past, and typically some unique advantage in their industry. On the short side, it could be a number of things. It could be leverage, certain visible catalysts, structural issues with the business or the industry itself. So I mean that's sort of the broad way I approach picking my stocks, and I'd be happy to talk about some of the examples of stocks that I've picked in the past.
Yeah, I think that would be helpful to kind of illuminate the approach if you could maybe walk us through a case study of a company that, how you came across of it, what was the work you did, and then what convinced you that was a good investment, and how that unfolded.
Sure. So let me actually talk about the very first two ideas, the first couple of ideas that I published when I started my firm. And they were both incidentally published at the end of March 2009, pretty much when the market bottomed. But what was interesting was they were both short ideas at the trough of the market. And the two stocks were Leap and PCS, both telecom carriers, prepaid carriers. So how I found out about them, I had covered telcos in the past, so I knew about those stocks, and I knew that they were flying high. But there were certain things about the business model which I didn't feel comfortable about, and so for any telecom carrier, right? So the fixed cost is typically very large. So the fixed cost can consist of building and maintaining new cell sites, the store costs required to sell the equipments, and obviously the sales and other administrative costs. A lot of parts go into the fixed cost, and the fixed costs tend to increase more when the carrier is trying to enter into a new market. Okay. So in the case of Leap and PCS, they've both acquired spectrum in 2006 from FCC auction, and they've been growing their subscriber base pretty widely. But what that meant was every time they entered a new market, their fixed costs kind of stepped up, which is not a bad thing. Growing revenues is not a bad thing as long as profitable growth, and that's where really I found the holes in their business model. So what was happening was the ARPUs, the average revenue per unit of equipment sold by both these guys, were declining over the last 5 to 6 months. So they were basically acquiring customers at the cost of profitability. Sprint already had a failed merger with Nextel, and they had a ton of empty spectrum. And what they were trying to do was move from postpaid into prepaid model. So what that meant was, Sprint, being the lowest cost carrier among the top three, was willing to compete on price with not only the top two guys but also with the bottom carriers. So that was going to put pressure. They had just announced that they would sell sell $50 prepaid plans in some of the same geographies where Leap and PCS operated, which is Chicago and some of the other metro areas in Texas. So there was a bunch of things that could go wrong with them. Then on top of that, if you ran the model for both these companies in terms of their growth, and if you looked at the historic growth, right, so the market was obviously excited about the fact that they were all growing at about strong double digits, 25 to 30%. But all of the growth came from entering into new markets, and especially the Chicago market was one of the biggest markets, and their penetration would kind of stall at the end of 2011. And in order for them to grow at similar rates, they would basically need to buy either more spectrum or be able to penetrate more into the existing markets. So both scenarios seem tough. So entering the new market meant another huge fixed cost, and there were no spectrums for auction back then. What that could mean is they could buy it from other carriers at a significant cost, or if they tried to penetrate the existing markets, they would have to compete with all the postpaid guys, the AT&Ts and Verizons. where they held pretty much 82 to 84% market share. So pretty much on all fronts, they seemed to be in trouble. What was additionally attractive as a short candidate here was A, the valuation, B, their debt profile. So the valuation, if you compared Leap and PCS to their comps, which was AT&T, Verizon, or Sprint, and if you did the math on, let's say the per subscriber total price value, AT&T and Verizon were trading about $1,500 each, and Leap and PCS were also trading very close to that value. Although the debt profile for Leap and PCS was much more horrible. Leap was trading at about 7 times debt to EBITDA, PCS about 4.2 times EBITDA. Then they were having this debt, coming due over the next 1 or 2 years, and there was a huge spread crunch going on in 2009. So it kind of seemed like a perfect storm for both those stocks, and that's when I put out my short thesis on them. They announced their numbers 3 months later in their June quarter, and that was dismal because their Chicago rollout was almost complete, and their growth rates fell from 35 to 20, and then the stock plummeted basically. And since then, it pretty much never came back. So that.
And where do you see these stocks, over the next several years? Do you think these are viable businesses that were just overvalued, or do you think they're so burdened financially that they may not make it?
So there are two parts to their business, right? So in terms of their value, so A, the value obviously lies in the number of customers and whether they're profitable or not, and B, the value lies in the spectrum itself, the spectrum that they own. So in terms of the subscribers that they have, it's a very tough battle for them to steal subscribers from the postpaid guys. So business model wise, they already have a challenge there. Their debt profile makes their cash flow pretty cumbersome, and what that basically means is they're not profitable. If you projected their earnings, and this is again, I remind you that I published this idea in 2009. So if you projected their free cash flow back then, and even if you take the actual numbers since then, essentially they could not even get free cash flow positive for the next 4 years until they could achieve a 20% growth rate in their revenues. So business model wise, it was tough, because they have this huge free cash fixed cost, and they cannot grow their revenue. So business model wise, it's tough. There's still value to those companies because they own spectrum. So obviously the value of the spectrum is at least the floor value of their business, and that's why you see basically some of the lower end carriers struggling to be profitable, trying to merge together. So Deutsche Telekom through T-Mobile is trying to buy Sprint PCS, and essentially they're trying to acquire more spectrum to sort of distribute their costs across these guys.
And do you have any opinion on how the value of the spectrum compares to their net debt? In other words, even if the spectrum has a certain value, does that, could the equity still be basically worthless?
In their cases, there was in both their cases the value of the spectrum was substantially lower than the value of equity, and you could have seen that pretty evidently because as soon as they announced their quarter in 2009 June, the next thing they did was, which was kind of a smart thing for the management to do, was they went out for an equity raise as well as a debt raise, both together, and they were both sort of negative catalysts for the stock, and essentially that kind of sent a signal to the investors that the management was obviously diluting them. So yeah, the overall value of the spectrum and the assets was definitely much lower than the equity.
And I guess going forward, do you expect them to ultimately get acquired by some of the larger guys like Sprint, or what happens in your mind with these companies?
Right. I mean, so going back to my point, so the spectrum definitely has value for both of them, right? And essentially what has happened in the last 5 years is that the top two guys, AT&T, Verizon, through acquisitions and other means, have increased their market share. So there's very little piece left for the remaining guys, Sprint, Leap, T-Mobile, PCS, and US Cellular. So given a smaller pie, not a profitable business model, they're really left with no other alternative but to sell themselves to other players. Now, AT&T and Verizon obviously may not be necessarily able to. AT&T, I think, tried to buy PCS, but it was spurned because of regulatory reasons. They may not be able to acquire. So that would leave you in terms of the potential acquirers, maybe Sprint or T-Mobile, or foreign companies, maybe something like Docomo or South Korean SK Telecom, South Korean Telecom. Some of the potential bidders which have shown interest in the past, but yeah, ultimately these companies will get bought out. If you go back 10 years in their history, right? So they're both pretty old companies. Both had to file bankruptcy 10 years back, Leap and PCS. I believe today the situation may be a little different because the smaller players, all the players after number one and number two, are all hungry for spectrum right now. So they might be able to find suitors before they have to file bankruptcy.
Interesting. I'd like to shift gears toward a little bit more higher level question on this kind of long and short idea generation. A lot of folks will say, I invest only long, or I focus on short, because the skill set and also the psychology is different. And since you have experience with both, maybe you could just explain the different approach that you take to generating ideas on the long versus the short side.
Sure. So on the long side, let me start with the long first. So on the long side, I tend to focus on good businesses. By good businesses, what I mean is, in terms of my criteria, there should be something unique about the business model. The balance sheet should be strong. Return on equity should be higher. So there should be some signals of historic strength in the business. Preferably low volatility in their earnings profile. Other things include the sectors that I've covered in the past. Sometimes the ideas on the long side can come from unexpected sources, maybe a conference that I attend. So, for example, one of the stocks that I got, ProAssurance, an insurance company, was from an insurance conference that I attended. And then there can be events in the market that can help me get the long ideas. For example, the BP spill gave me a ton of energy names, which were not necessarily E&P names, but more second derivative names who were in the drill equipment and drill ship owning rental business that were at very attractive prices back then. So in terms of longs, obviously, those sort of variables is where I tend to look. In terms of short, I'm very inspired by Jim Chanos. He spoke at Columbia way back, and I think he summed up the approach to finding shorts really nicely, and I don't think I can do a better job than that. The concept, what he said was, with a short, everything is against you. When you go short on a stock, the leverage you're putting on, you're basically, if there's anything slightly positive that goes on, the margin call can take you out. A ton of things that go against you. So what you want is at least one variable on the short side that works for you, and that variable can be leverage. So if there's excessive leverage and poor business model, at least the leverage is on your side. Every day there's an interest burden building up, and the company is obviously, it's like a time bomb ticking to death. So that's definitely one theme that I really like in terms of finding short ideas. Leverage plus poor business model. Now, leverage can be straightforward, where you can see it in the balance sheet, the debt, or it could be hidden in terms of operating leverage, or it could be in terms of the leases in case of retails. So, for example, retail companies may have 10-year leases, and they're long-term commitments, but they would show up as expenses in your income statement and not as a long-term debt. So those are definitely some of the things I would look for shorts differently. And in terms of, as you mentioned earlier, I'm working on a short book, trying to outline the way I think about shorts. And the way I've categorized the short screening process for finding short ideas is a bunch of things. So, like I mentioned, the leveraged business model, both at operating level and financial level, is really a good place to start. High valuations, but high valuations themselves are not reason enough to short companies. Evident cracks in the business model. That's number two. Number three, commodity-linked stocks. Sometimes futures markets in commodities can give you a great indication of short ideas, especially for commodity companies, which are highly levered, and their earnings are coming up in the next few months, and the decline in future prices is not priced in. So those are definitely great places to look. Investigations. Once an investigation is announced, it becomes very interesting to watch the company and look for other cracks within the company itself. Investor announcements, investor days, those are very important catalysts because it lays out, especially if there's a change in management, lays out a change in vision and things like that. And it's easy to figure out whether the plan for the company for the next 3 months, 6 months, or 8 months seems more promising than it has been in the past or not. Other places to look for as a short is, if the company loses a key client or key product. So sometimes, people would tend to jump into those stocks thinking the price action essentially means that the company is cheap now. But in case of some companies, the business model is overly reliant on one client or one product, and never tends to recover once that client or product is lost. So those are definitely other interesting areas in terms of the shorts and that I like to look at. And then, industry trends in terms of, secular decline. And then obviously the accounting issues as well. That's the hardest one, probably requires the most amount of work among the categories that I mentioned.
Now, maybe we can talk a little bit more specifically about a couple different industries. One that comes to mind that's been very prominent in a successful short is for-profit education.
Right.
I wonder whether you've looked at that, whether you still have an opinion, and if you do, how do you kind of balance the fundamental thesis versus the valuation of the stocks themselves? Because in for-profit education, the stocks have come down so much that maybe even with all the negatives, they could be good investments.
Right. So I don't have a great understanding of the for education business. I've spent some time on specifically one stock, which was Apollo, and that was for a specific client way back in 2011 when the stocks just began to fall, and he wanted to get my opinion on Apollo. So I can probably talk a little bit about Apollo, but I cannot make a comment about the industry in general, especially where they are right now, because I haven't looked them in the last 6 months to a year more closely. But Apollo I can definitely talk about. So in terms of the business model for Apollo, I recommended my client not to get involved with Apollo. At that time, I didn't go short, but I said there was a huge downside to Apollo, and this was an analysis that I sent out in August of 2011. So essentially, the problem with Apollo, and I'm guessing with some of the other for-profit education companies, was that the business model was reliant on one specific client, which was the federal grant. So what it meant was, for example, the University of Phoenix generated about 88% of its cash-based revenue for eligible tuition during 2010 and 86% in 2009 from Title IV financial aid programs. Now, Title IV is part of that federal grant program and federal loan program that I was talking about. The issue with that business model was the 90-10 rule by the federal government implied that any institution that derives 90% of its cash basis revenue would be ineligible to participate in Title IV programs if their revenue dependent on these programs for more than 90% 2 years in a row. In case of Apollo, they were eerily close to that limit in 2011 in July. And there were a lot of regulatory changes coming on. Beginning of 2012, there was supposed to be a new regulation passed, and what that would have meant was their business model would come into question. So in such a scenario, it is very hard to figure out what the margin of safety is in such a stock, because if you're not able to, get the revenues from your only client, or rather your largest client, which is the federal government, because you become ineligible because you were too heavily dependent on them for 2 years in a row, more than 90%, then your downside could be pretty much anything. You could even go out of business. So that's one of the reasons I recommend no. And obviously there's been more clarity since then, since 2012. But the four education companies continued decline because of their over-reliance on one specific client. I don't know if that answers your question.
Yeah, definitely. And I think, one point is, as we are speaking now, Apollo is maybe at $17 a share, and it's down to $2 billion market cap, and they've got a pretty sizable net cash position any way you look at it, even if you strip out their kind of a tuition liability. So I guess one question is the stock now reflecting the fundamentals? And the other point I just kind of was wondering about, as you talked about the 90-10 rule, to me it just seems kind of like a great example of a toothless government rule. I mean, 90-10, 90 is so high. Like, if you want to, make it hard, make a 50-50 rule, or say you can't have more than half your revenue from the government. But 90, I mean, if you can't figure out,
I cannot be your only boyfriend.
Yeah, I mean, if you can't figure out how to get 10% from some other ways, I mean, you could sell books or something. Who knows what? It just seems like, people are really worried. But to me, when the government comes and does something like a 90-10, it's almost saying like what happened with, Moody's and S&P, where, okay, fine, now there's this lawsuit against S&P, but ultimately there was just so much evidence against those companies with the ratings on subprime and things like that, and ultimately nothing happened. I just wonder if people kind of overreact to what the government might do.
No, and that's a very fair point. That's a very, very fair point. And again, I just do want to remind that my analysis is from 2011. But if I were to look back at Apollo today as a long, I would ask two questions about Apollo. Like you mentioned, so obviously the net cash position, good net cash position, good balance sheet is definitely a plus for them. Obviously, education sector has kind of beaten inflation by a wide margin in the last 10 years, public or non-profit or for-profit, both in the U.S. So I think the long-term prospects for the industry are pretty intact in that sense. I do agree with that. However, I do want to, when I talk about a specific company like Apollo or Stray Education or anybody else in the space, I do want to see how their business model is going to evolve over the next 4 or 5 years. So they might have all the cash flow, they might have all the net cash position, but if the 90-10 rule, or I don't know, whatever the new current regulations require them to be, still poses threat to their business model, in terms of their viability itself, then it becomes very hard to find the floor price, right, or the margin of safety, if you will, as a long investor, and that's something very important to determine when you're entering into companies which have already been shunned by the market. You want to make sure that the market is emotional about it and not right about it. And I think it's very important to, like I mentioned, so to figure out that regulation. If, let's say, for example, right, so it's a very binary situation. So, for example, if the government rules that, some of these companies have breached their 90/10 rule and they're not eligible, just a shock factor can drive down the stock from wherever the levels they are right now to even more ridiculous levels. But if there can be ongoing concerns, then you can definitely make a long case for all of these guys because they've been hit hard by the market and they could be in easily 2 to 3 times returns here. But I think a very important call here is to have an understanding of where the regulations would go in case of these companies. If you do not understand where the regulations would be, it may be a tough call. If you want to play it from a risk-reward point of view, it may make sense also if these guys have 2 to 3 times upside potential, and obviously the downside could be something like 50 or 60%. The risk-reward may be in your favor. So from those 2 angles, it may make sense to invest in these companies. But again, I would still want to find out, how the regulations would play into this in terms of the viability of their business model itself.
I now want to step back again a little bit and talk about the risk of short selling. Obviously, as a position goes against you, unlike on the long side, it actually gets bigger. So how would you think about sizing of a short position and then managing that exposure as a short position goes up in price rather than down?
Right. So I am an analyst. I do run a small proprietary fund of my own for the last 7 months. So in terms of portfolio sizing and managing, I'm definitely not an expert, but I can tell you what I think about controlling risk on the short side. On the short side, like on the long side, you can manage your allocation, and you can put size limits, sector limits in terms of the concentration on the stock itself, and like some of the great managers do, you can have strict risk limits. So, for example, if a stock moves 20% against you, you close the stock first before you find out why it moved 20% against you, just as a rule of thumb. So that's obviously a call that went bad, but it's water under the bridge. You move on and try to figure out where you went wrong with that. So there's a number of ways you can manage risk on the short side. For a little more sophisticated investors, I think who hedge funds and others, they can use options to sort of limit the downside on the short positions. So whatever they put in terms of the option position is their maximum loss that they can have on a specific stock. You can, there are ways. A lot of the short investors, go and buy protective calls on their short positions, and that sort of protects or hedges their short positions themselves. So there are a number of ways that portfolio managers do it. In terms of putting on an analyst hat and figuring out how you should worry about the shorts going wrong, I tend to focus a lot on the catalyst, things that can go wrong in the next 4 to 5 months. And if the laundry list of catalysts is more than 5, then there's always a good chance that one of those would work out. So that's the way I try to cushion from an analyst point of view on the short side.
And what is your view on kind of some of these investors who are very vocal about their short positions, essentially, doing the research and then going out and trying to convince others that a company is a fraud, let's say like Herbalife? Do you have a view on on that?
So the book that I'm writing, one of the chapters is titled Papa Bear, and what it basically says is coattailing marquee investors and betting against them. So essentially, the way I view about this, a lot of the vocal short sellers are highly reputed, very well established fund managers with great track record in the past. Um, a lot of them on the long side, a lot of them on the short side, a lot of them mixed. And if I think of a variety of investors, um, you know, it's very hard to recall one particular investor who does short only, other than Jim Chanos. Most of the other short investors, for example, like you mentioned, Bill Ackman in the case of Herbalife, or David Einhorn, they are both long short managers, so they do both. So you do not know what the other side of their portfolio or their hedges in terms of their positions. But you know, in the case of Bill Ackman, typically the short ideas that he publishes, going all the way back to MBIA, are obviously very detailed, very pointed to the business model itself. But the issue there is, I mean, most of the stocks where you'd see the reputed investors involved, they become a hotbed for speculative investors already. So by the time they get in, they announce, the stock starts moving 20% up or down on any given day, pretty much. So you, as an individual investor or as a professional investor, would need to have your own view on the investment itself. The great news is that you already have the 300-page thesis from Bill Ackman or David Einhorn or Jim Chanos that you can go through and try to find confirmation or confirmation on those theses. Do your own research. But typically, it's always harder to coattail them because once they've entered, the short interests are going to be huge on those stocks, and they might definitely benefit from it. But as an individual or as a follow-on investor, it may be very hard to make money off of coattailing them.
And as we finish up, Amit, maybe you could just tell us a little bit more about your book. When is it coming out, and what is the structure of it?
Sure. So I think it probably would be another few months. So far, I've written about 70 pages of the book, and a lot of it has examples from my own career in the last 7 years, and also some examples in the public space, including the Herbalife example that you quoted. So I think probably in those 5 to 6 months, I hope to finish the book. I want to add another 70 pages, bring it close to 150 before I go out and begin the publishing process.
Well, great. I wish you all the best with finishing it. I know from personal experience it's never easy to actually get it done, but we do look forward to seeing it in print.
Thank you very much, John, and thank you very much for taking the time.